How is everybody? Welcome. It feels like it's been a while because when I miss one of these, it means I don't see you guys for 2 months. So there's probably some new agents in here. And if there are, welcome. If you are a guest, welcome. My name's Vija Williams. I'm the president of Ben Kinney Keller Williams. So we've got about 11 Keller Williams offices in Western Washington. And I am thrilled to be joined today with some people that are smarter than me. Anton Stetner, are you here, my friend? There you are. Maybe you're here. I can see you, but not hear you.
I'm here.
You're here. Okay, hold on. It's always fun when I do that because then you become so big. We're going to have a fun hour, Anton, because you and I geek out on this stuff. I mean, like we couldn't even get off the phone this morning. We were talking so much about
We had to have a pre-talk before the talk just to talk about the talk.
Yeah, talk about the talk. Okay, so before we toss it to our first guest today, Robin has put up a poll. Robin, I can't see the poll. I think it's because we're both logged into the same account. I'm not sure. But can you share with everybody what is on that poll and what the outcome is? I'm curious.
For sure. So the question is the real estate market cooling down? We have been pretty much neck and neck. About 40 of you had answered, and it's 54% yes, 46% no. I'll go ahead and end that now. So you guys should all be able to see that.
Fascinating. I am a little surprised, and we'll talk about that later. I would have thought more people would have said differently, but you know what? I'm thrilled about it. And as you guys know, I want to start this meeting and I want to end this meeting with the same thing. The market never determines if you're successful. It simply determines how you're successful. And I think it's really important that we start any conversation about, economic outlooks, forecasts, Anton, anything that has to do with real estate prognostication, I should say, that we preface it by that, right? Like this isn't us saying you will be successful or you won't be successful in the near future. It's just saying, hey, your tactics might have to change a little bit.
You can literally make your own market based on your activities inside the market. And then every market, I remember when you and I first met in the recession and there was months and months worth of inventory, there was still massive opportunity then. Yeah. So there's always opportunity. It's just sometimes it moves or changes a little bit.
Yeah, you're 100% right. This morning, you and I got on the phone and we were both like, all right, like, what do we want to get out of this meeting today? What more importantly, what do we want the agents to get out of this meeting? So I thought I would kind of launch this by sharing with all of you guys. By the way, I would get your pen and paper out. We have some great guests and we're going to give you some really interesting things today. My goal for you today, okay, is to get out of this two things. Number one, I want you to have an informed and data-driven opinion and knowledge about the market. 100%. What I want for you is when people say, how's the market, what's happening, is that you actually have a data-driven, real, backed up answer. Yep. That this not just coming from, I think it's good, I don't think it's good, no thinking, no anecdoting, that, these are data, this is facts, and you're getting it from experts. That's my first goal. The second goal I have for you guys is that you can use this to get more business, right? We can always use information to get more business, and Anton and I are going to go into that later.
So, and Vija and I talked about this real quick, but this market is getting more towards the fundamentals of real estate. So if we're always practicing the fundamentals and we can become that local economist that understands the zip code we always work in, the neighborhood we always work in, you can deliver that elevator speech in a manner that's not just, I feel about something, here's where the market's going and why.
Yeah, that's right. One of the things that I've been noticing, because I don't run anything. I have great people who run it. I help lead our brokerages, is that a lot of you guys are making more money. Yeah. put it in chat. Have you made more money the last 12 months? Some of you, the answer is going to be yes. Some it's going to be no, by the way. But a lot of you guys have all, been making more money. I would challenge you to look at your units versus your volume. Because what's happening is we've gone up 50% in the last 24 months here in the Puget Sound real estate market. And some of you guys are relying on that volume increase, not unit increase. And a growing business is a growing business of units. And so I'm not saying that, to come down hard in any way. I'm just saying that this is the way we are now probably going to have to think in a shifting market as we head towards a more normalized market, by the way. And I can't wait to hear from Jesse and Todd Britsch today, but I just kind of want to challenge you on that. Are you making more money because you're selling more units, or are you making more money simply because the units you're selling are increasing in price?
So another way to say what Vija just said is you used to be selling a $600,000 house, and now that house is $900,000. So you sell two houses and your commission looks the same, when the reality is you should be selling three houses just like you used to and having a higher commission. So you got to watch out for the trap of volume, because it unnaturally rewards you during an appreciating market.
That's right. So I'm gonna introduce our two guests. So you're going to see the four of us, a lot over the next hour, and then we're going to toss it to Jesse for a while. But we're going to Todd Britsch. Todd and I go back. Todd, I think since we were kids.
Yeah, we were tiny.
And we're not going to go into years there, my friend. We're just like 30 years, Todd. Weird.
No, try 40, but it's okay.
Hey, Todd. Don't out me. They all think I'm young. No, they really don't.
You both look great.
Oh, well, thank you very much. So Todd's amazing mother founded New Home Trends, and Todd very soon partnered with her. Is that accurate, Todd? And you've been working in the new home industry, market research, market data space for decades. Yeah.
And I've always incorporated resale into my housing forecast that I do, because as we know, the real estate market they intertwine, it ebbs and flows. They have similarities. They also behave differently at times. And this has been a really interesting year because they did the complete opposite. New construction plummeted in sales velocity, and the lack of inventory caused this frenzy, and it added to many of the other components that created the frenzy in resale.
Yeah, I love that. Well, we're gonna talk to you about all of that in a bit. I do want to introduce Jesse Passifiume. A lot of you guys know Jesse and know his face. He's the president of Ben Kinney Mortgage, and very, very plugged in on the national stage, and lives and breathes this, running a national mortgage company, right? So Jesse, I think I told you, I think my words were, you are the star of the show. Interest rates are sort of the conversation right now, and what's kind of launching this potential market shift that we're seeing. So I think we're all going to take a step back and just hand you the reins for a while, my friend, and have you talk to everybody, if you're cool with that.
Yeah, absolutely. I think the thing Vija didn't tell me is that Todd was going to be here, and I had to do an economic discussion in front of Todd. So I'm a little nervous about that. I am a sales and marketing guy who obsesses over what's actually happening. So I am not an economist or an analyst, but I play one on Zoom from time to time. So thank you for being here, and thank you for having me. I've got about 5 slides, talk a little bit about this recession word that we're seeing. Todd, I'd love to invite you to jump in, and if I misspeak or you want to add any color. Let me just get into my screen share here. This is always my favorite part of the show. All right. I think we're in. And boy, it has been an absolutely wild ride on interest rates, right? And we're seeing this. This has moved faster than anybody expected. We've all been talking about it hypothetically, that rates can't stay this low forever. but the velocity with which rates have changed, I think, surprised pretty much everybody.
It was whiplash fast, Jesse.
It was
whiplash fast. Yeah.
How fast was it? It was this fast.
Yeah.
So if you're interested in understanding what rates are doing, we watch the 10-year bond yield, and that it's actually dropped a little bit this morning. It's actually dropped a little bit this morning below 3%, but it popped above 3% for the first time since 2018. And it happened, I mean, basically, from March to the 1st of May, and it has been a straight line up. So interest rates have gone up. I think I've been on this call multiple times talking about the cost of waiting. So I'm not going to go into that again, but let's talk about what's happened. The average 30-year fixed rate is running about 5.5% right now. We're talking about coming off of lows in the threes, low threes, up to 5.5% in a couple of months. So it's caught a lot of people off guard. In our little mortgage platform, we're sitting on about 300 TBDs, and we've seen between 30 to 40% of those no longer qualify. The good news is that 60 to 70% still qualify just fine. Right. That's the point we have to make. And the primary driver of this run up has been inflation. We have new inflation numbers coming out of China and the US tomorrow. So this presentation could change on Thursday, but right now we're sitting about 8.5% annualized inflation. We're all feeling that. Our buyers are feeling that, right? We're feeling that in every area of our lives. But this is the highest it's been in 40 years. And we'll talk about, how you have the highest inflation numbers and the best employment numbers in a long time, and you end up in a potential recession. We'll get to that in a second. What the Fed has done is they increased rates by 50 basis points, 0.5% last week. And the way this works is that counts as 2 interest rate increases. We are very fortunate that they didn't go 3 quarters, right? So, and we're not sure exactly, what they were thinking, but the commentary was that they're going to wait and see what inflation does this week. But we will see another increase in June, and we could see as many as 9 total rate increases this year. So our view is that interest rates are going to continue trending up. There's always for the intermediate for the intermediate future. Somebody asked me if we're going to see 7% interest rates, and I think it's very possible. And you know what that does to your market. So we're watching this closely. And to Anton's point, there's always opportunity. You just have to know where to find it, right? What we did, and this is not a plug for us, but we lowered our 30-year fixed note rate by about 0.25%. So we took margin out of the price, and that's something that you're seeing a lot of people doing. And we have to begin acting differently, right? So on the mortgage side, we're taking margin out of our price, and we have to become more efficient. So as this market changes and evolves, we all need to think about how we can be more efficient. If you're interested in watching 30-year fixed rates, my favorite source is this little app called Mortgage News Daily. They have an iPhone app, and they tell you the average 30-year fixed price on a daily basis and tell you how it's trending. So Mortgage News Daily, a great iOS app. They have a great Android app, and they're really sharp folks. I've been following them for a long time. And I pop it open on a regular basis and take a look at where rates are at. So that's what's happening with rates. We're sitting at about 5.5. We're probably sitting at 5 3/8 now. I think we just saw rate improvement come across, but that's a little blip from yesterday's, bashing essentially. So keep your eyes on this, but we're going to stay in this 5.5 to 6% range for the foreseeable future. If inflation numbers come out tomorrow and we do not see any cooling, or we see an increase in inflation intensity, I think we'll see the Fed become more aggressive. Now,
where did you say we're going to live in the near future? Can you repeat that?
Yeah, between 5.5 and 6 looks like a landing spot based on kind of the floor and ceiling of this 10-year treasury.
And Jesse,
So-
I got a private message question. She asked,
Yep.
what does it mean taking the margin out of it? My assumption is that you are lowering rates and taking your own profit margin out of that, is what you were referring to. Is that correct?
Yeah, we are decreasing we've decreased our gain on sale, essentially our margin. Yeah, that's how we get there. And the mortgage business is interesting, and it's probably not interesting to you, but Q1 was a bloodbath, right? Because the mortgage business lost all of our refinances as these rates started running up. So you're seeing more and more mortgage companies kind of focus on purchase transactions now, which is creating a lot of noise, by the way, because folks that are not highly tuned for purchase transactions, or your favorite loan officer that's been too busy for you for the last couple of years, it's a real problem. So we need to be very thoughtful as agents that we're using loan officers that are tooled and tuned for purchase transactions, because there's a couple other things going on that I think are worth mentioning, but there's huge reductions in staff going on at most mortgage companies in order to, deal with decreased volume. So you want to be thoughtful in your choice around mortgage, and make sure you have somebody that's fully staffed who can close on time. Because the flip side of that is the real estate market's still hot, right? All right. So let's talk about recession. It's really interesting to talk about inflation, lowest unemployment numbers we've seen in a very long time. Biden's talking about his reducing the deficit. All this stuff is going on. And at the same time, you're seeing these recession headlines. And when we're talking to buyers, we're having a lot of discussion about, well, why don't I just wait? There's a recession coming, right? I mean, aren't interest rates going to drop and home values are going to collapse? So I want to just give you a little information about a recession. And what happens is the economy heats up, and the economy has been on fire. I mean, the economy kind of post-COVID has really caught fire. It impacts every aspect of our lives. And then it was compounded with the issues in Ukraine, right? Limiting oil supplies and creating uncertainty in the economy. So the Fed, the primary tool they actually had two tools. One tool is to stop buying bonds and artificially propping up the market, which they have done. The second thing they do is they increase rates. So they increase rates to cool off the economy. And the question is, are they going to create a soft landing for the economy or not? And listen, what goes up must come down. So the general thinking is that it's going to be really hard to create a soft land. So that's why you're seeing all of this recession talk. Technically, a recession is 2 quarters of declining gross domestic product. So 2 quarters of declining GDP. Now in Q1, we did have a slight decline in our GDP, but it was not that significant, and it was mostly supply chain related. So the belief is that Q1 was kind of a wash. So we're going to see what happens in Q2. But the funny thing is that we feel a recession way before there's one actually officially declared. Okay. So a couple of keystones of the recession: stock market decline. I mean, the last 4 or 5 days have been wild, right? Increased layoffs, lower wage growth. We haven't seen the lower wage growth kick in, but we are seeing increased layoffs, and it's extending beyond financial services into the tech sector. I'm in Northern California. I'm about an hour and a half away from Silicon Valley. And we're seeing a lot of layoffs in tech, especially in startups. So that's an interesting indicator. The bubble of the moment popping. And the bubble of the moment is not real estate, by the way. I'll jump all the way ahead there. But what's going to happen with crypto? That's been a big question. We're seeing huge declines in the crypto markets, especially the altcoins, right? So we're watching that closely, and we're going to see if this is the bottom and it bounces up, or it keeps going. The other thing we're going to feel, and listen, a lot of this becomes self-fulfilling prophecy, but this doom scrolling, right? I mean, these headlines are ridiculous. I mean, the Deutsche Bank economist yesterday said, we are heading to potentially one of the worst recessions we've seen in decades. Okay. And then the Goldman economist the Goldman headline pops up a few minutes later and says, maybe. So I want you to be careful about what you read and what you consume and how you communicate with your borrowers, right? Or with your buyers and your sellers. So it's really important that for every negative headline, and I think social media, social media has compounded this, right? Because I can post, if I choose to post recession news on my Twitter feed all day long, that's what you're going to get if you're following me. So we have to be careful about what we consume and always look for the counterpoint, right? Always look for the counterpoint and be prepared to share that. Vija mentioned that we need to be experts, right, in the economy, and we need to have our elevator pitch ready. And one of the things I tell people is, they'll send me an article from the New York Times about, is the housing bubble going to burst, and it's very pro housing bubble going to burst. And I will fire right back with a Wall Street Journal article that says housing bubble's not going to burst, right? So we don't know what's going to happen. That's the reality. I mean, I sell stuff for a living, but at the end of the day, we do need to be able to communicate thoughtfully with all of our clients. So how does it feel in real estate? There's some good news. If we do end up in a recession, rates are going to drop. So I just said we're in this 5.5% to 6% range. I wouldn't be surprised to see us run to 7%. But when it slows down and when the general consensus is that we are entering a recession, we will see rates drop. And this is the funny game the Fed plays, right? Is that they have to increase rates to cool off the economy. Then when the economy cools off, they're going to lower rates to fire it back up. It's they're just chasing their tail. And they do the best they can, I think. I don't have an opinion either way on them, but we know they change their mind regularly. I didn't know how to say this, and you guys are in the markets, you can say this better, but there's incredible pocket values that come out of these markets. And like in my personal market, I have 6 or 7 friends that are sitting on the sidelines with a ton of cash, and they're looking for that beat up house in a subdivision that they know they can put 20 grand into and cash flow. And so, I'm calling it pocket value. I think you guys are going to wrap this up at the end and give us some clear direction, but you have to start looking for value in your own market, and you have to help your investors find value. It is everywhere. Brings me to the next point, just investor opportunity. We have several people that have popped into our system that we've gotten pre-approved, that are just waiting to see what happens, right? Because as inventory ticks up and there's fewer competitive offers, maybe some home values start ticking down just a little bit. The highly desirable home, right? The one, in the perfect location is still going to keep selling, but the one that's slightly less desirable that'll cash flow well, there's going to be opportunity there. So we need to watch for it. We need to work with our investors. The other thing that happens is, you get some market rationalization. Anton said earlier that we get addicted to the volume number, right? From an economic perspective, this gives us an opportunity to rationalize the market down a little bit. So we get back to it. We call it normal. There's no normal, right? Where it feels like normal is a real moving target, but it's going to rationalize the market, which is wonderful. That means for us as salespeople, we need to make sure that we are focused on the right activities with the right buyers, right? The other thing, it's going to bring first-time home buyers back into the market, and they'll have an opportunity to take a shot and win. So from a real estate perspective, certainly from a mortgage perspective, I don't mind recessions. And just make sure I'm, sitting in cash personally, and I'm watching for real estate values. But from your perspective, you just have to retool the way you think about it. So is this going to happen? We don't know. Is it going to happen tomorrow? I will tell you, if the stock market, it's bouncing back today, but if the stock market keeps plunging and we end up with, deep crypto losses, we could definitely enter into this, into a recession, pretty quickly. But I don't think so. We'll just see what happens. But I just want you to think about what this looks like. Now, here's another piece of interesting news related to a recession, because the headlines are just thick, right? And it's partly because of what I follow, but the headlines are thick. This is a graph of 30-year fixed rate mortgages and then home appreciation. And these gray bars are the actual historic recessions. Now, here's the thing that's interesting is that during a recession, and this is somewhat counterintuitive, but in the 70s, home values increased pretty dramatically. In the early 80s, home values increased with a small drop kind of post-recession. In the early 80s, we did have a bit of a drop in values during that window. Values were relatively, I'm looking at interest rates. I'm losing my mind. Done this presentation 6 times. Let's look at the red lines. This is the better way to look at this. There we go.
Jesse, I actually have a slide on that a little later that we're going to show about how home prices have actually gone up during recessions.
Perfect. Got it. I'll go quickly then. So home prices go up during a recession. Here's the thing we all remember, many of us remember, is the 2008, right? And so what happened in 2008 was driven mostly by loose lending practices. So borrowers were completely overextended, and it created an environment in which there was a lot of walkaways and price dropped. Right now, we have more equity than we've ever had in history, and we have very well qualified buyers. So even a 10, 15, 20% drop, or if the stock market continues to plummet, people are not going to walk away from their houses. So this is an anomaly, and it's important you communicate that with your clients. I'll let Vija take the rest of that. So from a language perspective, I'm always thinking about ways to communicate this, right? We coach up our teams to talk to buyers, when I do my stand-up meetings every Monday and Wednesday morning, this is what we're talking about. So the question, do you wait to buy? Interest rates are trending up. Even if appreciation slows, home values are likely to increase, right? Either way, it gets more expensive to wait. And I heard somebody say this, it might have been Ben, but you have to decide when you want to pay more for a home, today or tomorrow, right? I think that's a very, very valid point. This recession question. Well, interest rates keep trending up to combat inflation and may ultimately trigger a recession, but rates drop. Historically, home values have increased. That is an important talking point, and it's important to have that data. So Vija has a slide later. I'll share this deck with her so she can send it out as well. And, when's the market going to crash? Talked about this a little bit, but that crash in 2008 that many people are waiting for, fueled by loose lending practices, this home value appreciation has been fueled by demand, right? We're currently 5 to 7 million homes short in the U.S., depending on what you read and what you look at, but we just don't have enough houses. So this is so different than 2008. What I do is I take my left hand and I go, this isn't 2008. And I just slide it off to the edge and end that conversation right there. And the other thing to remind people is that rates are going to trend up until the economy slows down. Once that happens, you can refinance. I had a conversation with a borrower yesterday, and it was like, well, I can't pay 5.5%. It was just 3%. I said, it's not 3% anymore. When do you think it'll get to 3% again? I think, I don't know. I'm thinking the economy is going to crash and it's January, February. I'm like, great. So you're only going to pay 5.5% until January, because then we're going to do a no-cost refi for you, and we'll just chase the market all the way down. It really is. I mean, the mortgage is a powerful tool. I'm not trying to sell homes now so that I can do mortgages later, but we are able to just refinance folks at no cost and just keep doing it, chase the market all the way down. So there's no harm. I mean, if you're in 5.5%, 6% today, we'll be able to chase the market and put you in a much better position. And you get to take advantage of the home price appreciation that we're going to see inevitably over the next few months, right? So we're also talking about good news related to interest rates. So I think we're going to get into this in the next presentation, but we're seeing inventories are in fact clicking up, right? There's part of that, like in Sacramento, inventories are clicking up, but pendings are down. So there's a little bit of fudging going on here because interest rates have cooled off buyer demand. But inventories are definitely increasing. So there's more homes to look at, okay? Our agents are reporting fewer offers on each listing. I know you're seeing this. We're certainly seeing this in Sacramento. We went from an average, I think, of 50 offers on a home down to like 27 in the last 2 weeks. So that is great, right? So it's slightly less competitive. And the other point we always make is, yeah, interest rates are high, but compared to what? This is still 5.5% money. When you look historically at the interest rate market, this is phenomenal. I mean, we are in much better shape. And I'm not the old man saying I bought my first house at 13%, in the late 80s. But interest rates, 5.5% money is still phenomenal. It's a great way to create leverage and grow your wealth. So we want to make sure people are clear on that. And again, all signs point to continued increase in home values. I mean, there is very, very little indication that home values haven't hit a new plateau, right? And you've all seen the graph. Home values over time in the United States go up and they outpace inflation, period. There's little blips here and there, but we don't anticipate there being a big blip. So this is how I want you thinking about it and communicating with your clients, right? And make sure that you are tight. As Vija said, you need to have your elevator pitch ready to go. I'll get this stuff over to you. And that's the end of my presentation.
Fantastic. Do you guys have any questions specifically for Jesse? He's gonna be here all hour. We're gonna be super interactive, but do you guys have any questions for Jesse specifically on what he talked about? Okay. All right. So Jesse, you're gonna stick around.
Yep.
I am gonna substitute you. You're never substituted, my friend.
Yeah,
I'm gonna bring in Todd. And Todd has the benefit of getting to, kind of hear what Jesse had to say with his overview of mortgage interest rates. And Todd, I would just ask you to kind of give everybody an overview of what you're seeing specifically in the housing industry. If that was the mortgage update, I kind of feel like you're the one to do the housing update. And then Jesse and I'll just kind of join you if you don't mind when you're done.
Yeah, absolutely. So I'm tracking data across multiple states, multiple regions, and I do it on a daily basis. What was interesting through this month is we watched even interest rates go up 25 basis points. As we tracked through the month of April, we actually saw the daily average number of sales increased in virtually every region that I track. And for this concept, and I'm right on par with Jesse, this is not 2008. And it's interesting because I Google so much and I listen to other economists and other housing experts, constantly getting feeds from YouTube. And there's probably 5 or 6 individuals on YouTube that are just absolutely doomsdayers and saying there's going to be a massive crash. And there just absolutely is not. One of them had quoted builders, permits are at an all-time high, starts are at an all-time high. Well, yeah, but for the last decade, 15 years, they've been at an all-time low. And builder margins were through the roof. So if they've got to cut prices, they got to cut prices. But I don't even see that happening. What's interesting right now is through this change that we've seen, demand has actually picked up. I've got a number of markets where sales are up year over year, even here in the Puget Sound. King County was down. Pierce, Thurston, Kitsap was down. Snohomish was up. Pierce and Thurston were up year over year. So go figure. I mean, every market's going to behave a little bit differently. And while inventory's up a little bit, we're still looking at, even if I don't do a 3-month trending, which is what I typically do when I look at sales numbers, if I take sales in the last 30 days and I'm looking at months supply, it's still counted in days. And for some of you, I mean, you haven't been in the industry very long. I can remember a day it was 6 months supply of resale on the market. And when it dropped to 5, it was, that was a great market. 4. And I don't think we'll see those numbers again for a long time. My guess would be probably a decade. The number of listings. So this again, so the market is acting so counterintuitive to its historical norm. This is the time of year where we see listings spike. May is when we see typical sales spike. And we're not seeing the spike in listings in many markets. Some we are. But we have so many consumers out there that refied at 3.25, and they're not going to trade a 3.25 for a 5.5. So they're not going to sell. They're going to hold their property. We've got individuals that may pull equity out and keep it as a rental. So inventory is going to be incredibly low for quite some time. And demand right now, in the next 12 months, millennials hit that absolute peak of household formation. And we are short 4 to 5 million homes nationwide. And as Jesse alluded to, I mean, the mortgage underwriting is completely different than it was in 2008. We don't have PricewaterhouseCoopers under contract by Congress doing mark-to-market accounting on all real estate activities, which was one of the fatal reasons for the crash that we saw in 2008. And while we do have the lowest, some of the lowest unemployment numbers we've seen, we're still struggling for labor force. The pandemic has forced, 500,000 to 1.5 million people out of the labor force because they just want to go retire. And that is a trend that's going to continue for the next 3 to 4 years. The pandemic, I read a survey that was done. Now, prior to the pandemic, quality of life was important to roughly 90 to 95% of employees, but only 75% of companies. Post-pandemic, 95 both ways, from a corporate standpoint to an employee standpoint. That's a huge shift. As we start to see the baby boomers fall out of the labor force, you got to look at that next generation that's down below Gen Y that's coming up right now. They're not going to fill the shoes of that labor force, so it's going to be a tight market for a number of years. And I was fortunate enough. I did a forecast for Vija's brokerage, and so I'm a little bit more pessimistic on the near future. But to be honest, I hope we go into recession, and I hope we do it more sooner than later. I think we're already there. The numbers just don't show it yet, and the reason I say that is that if the inflation continues at the pace that it's at, the Fed has the one option to essentially raise the Fed fund rate to pull the liquidity outside of the marketplace. There's two primary issues with that. And why the Fed is behind the 8 ball and not essentially leading as they should. First off, our debt now exceeds 30 trillion. If you look at the debt clock, it says 30 trillion, but that does not count the Fed's debt, which is 10 trillion on their balance sheet. So you're talking well over $40 trillion. Now we have to pay interest on that debt. As the Fed raises the Fed fund rate, what does that mean? That means that the treasury notes that we sell off onto the secondary market, those rates are going up, which is why you see the 10-year treasury now sitting essentially around 3%. Up until last year, our debt payment was $500 billion a year. That's a lot. But the average, and I haven't been able to find this exact data because the Fed does a really good job of burying it on their balance sheet, on what amounts of data are financed at what Fed fund rate. So if you do the math on it, you can come up with a general idea. So let's just hypothetically say it's average financed at around 2%. if the Fed fund rate raises up to 5, and we see the 10-year Treasury trading anywhere between 5, 6, and 7, the debt payment becomes unimaginable. You can't pay the debt payment. So the Fed's not going to allow that to happen. They're trying to shock the system right now and stop the inflation. And it's not going to work. And my belief is that the Fed is going to let this go for 12, 18 months tops, and they're going to realize that jacking the interest rates up is not working. And the reason it's not working is because it's not going to fix the supply chain. China is on an absolute complete lockdown right now. Their ports are closed. There's nothing coming out. And we will feel that in the next 6 to 8 months. So the inflation is going to continue. And then the Fed's going to realize that they have created a recession, and they're going to jump in and they're going to drop that Fed fund rate. And the next thing you know, we are right back in a housing boom in the next 18 months.
You know what's interesting, Todd? I remember during the recession, and I think it was 12 years ago, I think it was right around 2010, somewhere around 2010. I remember I was somewhere and you said, mark my words, we are walking into being undersupplied for well over a decade. And we are not building houses enough. Now, this was when I remember 2009 and 10, by the way, and little pocket, Anton, correct me if I'm wrong. I remember doing trend graphics at 18 to 24 month supplies. Now that, granted, that's some price bands in some areas, 18 to 24 month supply. And I remember going, what is Todd talking about? How could he be talking about this? We are so oversupplied, like it's going to take years for us to get out of this, right? And I remember thinking, no. And you have been right. That was 12 years ago. And you have been right.
So that I started that in 2008 when I started mapping it out, and I got death threats. No lie.
Wow.
And so what was interesting about that?
That just got a little sexy for the meeting.
I did a matrix where I looked at the in-migration trending analysis and the supply that we had in the pipeline and currently selling, and mapped that all out over a 7-year period. Well, it was a 5-year period at the time. And I went, January 2012, the market's going to turn. And I missed it by 30 days. It was November 11.
It might have been when I heard you then, because I kind of remember you saying that, because I've thought of you often over the last, 10, 15 years. Jody and Zach Hill as well, probably, that was kind of in our era when you were New Home Trends, and we were all, watching you a lot, and, we were all wondering what the market was going to do. Crazy times. I'm curious, just kind of pulling this back out. Jesse, can I ask you a question?
Sure.
You mentioned, I haven't heard this before. You mentioned crypto, and you said if crypto crashes, we're in for a ride. Can you go into what you meant by that?
Well, when related to a recession, right, and what's happening in the global markets, the crypto investment is pretty significant. I don't have the exact numbers, maybe Todd does, but what's happening is especially the altcoins have lost just a ton of value. So as a leading indicator for a recession, when you see a bubble pop, that is really, one of the leading indicators. So Todd may be right. We may be in it now and just it's too close to our face to see it. Yeah. But at the end of the day, that is the bubble of the moment is clearly, well, not clearly, one of the bubbles of the moment is crypto. And so when people are talking about 2008 and the housing crash, I go, listen, the thing you need to worry about is this crypto crash and what it's going to do to all of our, Gen Y folks who overinvested in this in the last 6 months, right? That's the real concern. And it's going to drive us into this recession faster.
Todd, what are your thoughts?
So it's really a deflection. It's really a deflection from real estate, right? This real estate isn't the bubble.
Yeah. So what's interesting? When I look at everything that's going on from a global standpoint to a national, all the way down to a zip code level, we are essentially, I'm reluctant to say this, but at war with Russia and China right now. We just don't know it yet. Why did China shut everything down when they know that lockdowns don't work? Why did they shut every city down when there was minimal cases that were happening? Why did they shut every city down when it's the variant that is like a common cold? There have been 28 food facilities that have caught fire in the US and Canada in the last 6 months. Russia has cut off all fertilizer that is shipped out across the globe. The Ukraine wheat shortage that is going to hit, and the sunflower shortage. I mean, so what all that's going to lead to is just, again, why I don't think the inflation is going to go away anytime soon. That is all going to hit in the next 12 months.
Mm-hmm.
So, and then why I think we're in a recession already is you start to look at the discretionary income, and we haven't even begun to see food accelerate in price point. So we're looking at 30-40% inflationary times on food. And we're reaching that point now where we've been in a high inflationary period for close to 12 months. So now it's going to start to compound. Now, for those of you that are online, as I said at Vija's office, this is not to create fear, it's to make you aware of what's happening. But again, so I'm okay with us getting into it more quicker than not, because that's going to cause the Fed to react more sooner than not. And they'll bring those interest rates down. So for those buyers that don't want to buy now, like you stole my thunder there, Jesse, if we go back and we look at home appreciation in the 70s, it was in the double digits at times when we were hitting hyperinflation. And, you know, even when we had interest rates at 11%, 12%, 13%. Now, granted, home prices were, I think my first house was $89,000, but it's all relative. It's crazy to think of that kind of appreciation. And really one of the biggest messages that you can pass on to your potential buyers. You have a renter that is imminent on, hey, the market's going to crash. Market's not going to crash. There's record low inventory. Everybody financed 3.25. They have record equity inside of their homes. It was strong underwriting. The labor force is going to continue to shrink as we move forward, so they're not going to lose their jobs. Unemployment in the recession, as we hit it, will probably peak out at 6. Not bad.
No.
Hey,
what
Anton?
is your safest asset in an inflationary period?
Yeah, well, the house.
Yeah, really.
A house.
Speaking of which, I want to bring it back down to our market and kind of make sure that we close out Todd, Anton, and Jesse with some news that they can use, meaning scripts, approaches, and ways for our agents to take advantage of this, right?
Vija, I want to drop a script real quick because
Good.
somebody said, and this is just a really good point for like, I want to wait or I don't want to do anything, you know, and they're a renter. One thing to understand immediately is you're paying a mortgage. You're either paying someone else's mortgage or your own. And that's just a simple fact of it. Okay, so whether you're a renter, you're literally paying someone's mortgage, or you're the homeowner, you're paying your own. And Jacqueline says here, you know, it's hard when interest rates are going from 3 to 5.5. What's a good script for all this information? You know, Todd already mentioned this. Jesse mentioned this. Yes, we may have to pay a higher payment for a moment in time. And yet, if the economy starts to change, like, you know, we go into recession and, you know, the Fed then lowers the rates again, all of a sudden it's going to be cheaper. And Jesse was talking about a product that they have that has a no cost refi. Was that correct, sir?
Yep, absolutely.
So So let's just say they did it for 20 months, and I'm making a number up. And for 20 months, they had to pay a higher interest rate. You could sit down with one of the loan officers and Jesse's team and go through this and figure out what the difference would be at, 3.75 versus 5.5, and then what that would look like. And it's probably only a few $100s owning today and then maybe refining at some later point. this is what I'm talking about when V and I were talking earlier. We need to get scripts where we can use chunks of data to articulate the difference, because that difference is a few $100s a month for most buyers.
So even if we go back to the annual average of appreciation of 3 to 5%, you take a median price of $500,000. That's $15,000 to $25,000 a year in appreciation. And so, gosh, I'm not going to buy. I'm going to take my money. I'm going to invest it in the stock market. Where else are you going to get a 3 to 5% return on $500,000 when you only have to invest an extra $200 a month into a payment?
Well, yeah. And guess what, guys? Rents are going up. And so I love Anton's script. One of the best scripts I've heard in a long time. Oh, you're paying a mortgage.
Can I add one more?
Are you paying yours or someone else's? Yeah.
I want to add one more. So the one thing for you guys to also be thinking about. So realize I'm a salesperson first, is that Jesse mentioned that we lost 25% of our buyers, right? Because of that rise in interest rates.
Yep.
If they're not buying, are they immediately a renter? Yes or yes? So that's putting additional pressure on rental rates to increase at a above average, above market rate over this same time period.
That's right. And Jesse, see the slide we have in front of us. This is an aggregate of every major specialist, CoreLogic to CoreLogic, Case Shiller, a bunch of different experts. The market is not crashing or going down. We are not going to rise at the same rate of appreciation that we have risen. That does not mean by any means that we are not going to appreciate, though. That just means that we're going to slow down that rate, right? Prices, the ship has sailed. So Jacqueline Phillips asked a great question. Hey, I've got these clients who are like, hey, I don't want to buy. It just gets more expensive to wait, and the ship has sailed. It is not going back. It's probably not going back in interest rates, and it's just never going back with home price. So the question is, if that train is going down the track, when are you going to hop on?
Absolutely. And I think we run into this trade-up question, right? I'm sitting at 3% in my $400,000 house. I want to buy an $800,000 house, but I just can't give up this 3% interest rate. That is such a flawed argument, because if you pop in at 5.5% into, an $800,000 house, just example only, we're still going to have equity appreciation. So you can begin to generate more family wealth and more opportunities. And oh, by the way, how important is lifestyle, right? We're not talking about goals in life. We tell people interest rates are what they are. They're going to go up. They're going to go down on a regular basis. So if it's 20 months or 15 months, you're stuck at 5.5, who cares? It's better than the 70s and 80s by a long shot. So, and then you can begin, this 5% appreciation has a far different compounding effect at $800,000 value than it does at $400,000 value. So if you're going to trade up, interest rates should not prevent that in any way, right?
Well, and Anton, this is the time I think that as agents, we have to learn how to start really teaching tax advantages of home ownership, how to teach, what that looks like, right? How to teach overall wealth building and overarching wealth building where real estate fits into that, right? We are in a skill-based market. This is the time to go back to the financial economic fundamentals of real estate and study up. And I have good news for you. All you have to do is get on Spotify and search podcasts for, economy, real estate, get on Dr. Google and search that. It's just not hard. What was that mortgage advisory? What was that great app you gave us, Jesse?
Mortgage News Daily.
Mortgage News Daily.
There you go. And Todd.
Phenomenal site.
Apparently. But it's not hard.
Todd, for the people on the call, because most of us are throughout the Puget Sound region, and I've looked at the new home trend stuff forever. How far are we behind on new construction in our area specifically?
So the last time I pulled the numbers, it was 120,000 owner-occupied homes.
So we're 120,000 units behind.
Yeah.
And then if I was to talk about that in number of units produced on a yearly basis, or how many years is that behind?
A decade.
So in your estimation, we're 10 years behind on new construction just to keep up with population and demand.
Yeah, and there's only there's less than a 5-year supply in the pipeline.
And there's less than a 5-year supply. So at a minimum, if everything hit today, we'd still be 4 to 5 years behind.
Yep.
And then, so,
you know, it's simple supply and demand, especially here in the Puget Sound. There's just no way. Now, there might be a hiccup. You know, you just never know what the Fed's going to do.
Yep.
It's hard to sit back and predict exactly what's going to happen, although I've been fairly accurate for a couple of years. But there are black swan events. Like,
always.
I mean, who saw the pandemic coming outside of Bill Gates and Knucklehead? So,
but the reason I want to bring that up, guys, is if we're talking with our clients, okay, Anton, I'm an investor. I'm also a developer. So some of my time horizons that I'm looking at are 2, 3, 5 years out, sometimes even a decade out on some of our projects or investments that we're doing. And when I look at the Puget Sound region specifically, even if we go into a recession and house prices dropped 10%, 20%, whatever the number is, realize, guys, what Todd just said is we are so far behind on new construction in our area, and we are not pro new construction, and we don't have new legislation coming to save you. And for most of our region, it's saltwater on one side and Cascades on the other. So we don't have a large available land. That's going to keep our region specifically prices very stable and then definitely above average appreciation over the long run. So if I'm talking to a buyer or investor in my area, just use Todd's numbers right there that, hey, yeah, it may not look great today, but over the long run, so unless you're a speculator trying to hit a home run today as a buyer or an investor, the long run for our areas, we just don't have enough houses.
In many areas, not just our area, because we have
many areas all throughout the country.
We're going to replay this. We're going to replay this tomorrow to a national audience. Todd, is there anything you want to pull out from that? Nash, are there any regions that does not apply to? Are there any regions that are not undersupplied right now?
Yes. Well, there's 2 areas of concern that I have, geographical areas. One is portions of Florida and portions of Arizona.
Those are the number 1 and 2 most appreciating markets right now. So you think they're in a bubble?
Ish. So companies like Open Door, pardon my French, need to go to hell. They will come in and they will manipulate neighborhoods. They can't manipulate an entire market, but if they manipulate enough neighborhoods, that will impact the market. So what they're doing is they're going in and they're buying anywhere from 10 to 20 homes inside of a neighborhood. And then they'll buy the last 2, just to make the math easy here, 300, and then buy the last 2 at 400, and then start listing everything at 450. So they've artificially restricted the inventory, artificially jacked up the appraisal, and they've done this over and over and over again. And I hope they burn in hell.
No, we don't hope they burn in hell, everybody. That is just... No.
Okay. I would be thrilled if they go bankrupt.
We have many of their we have many of their partners that watch us. Oh my God. This is going to be fun in my email inbox. I'm going to share those delightful love letters with you, Todd Britsch. That's going to be super fun. Hey, Anton, I do want to be sure. I think that one of the things that I wanted to, impart to our agents was showing them how they can pull data. I talk about turn graphics all the time. We don't need to talk about that today. Would you mind doing me a favor and hopping on Locator potentially and sharing your screen if you wouldn't mind, and showing everybody? You had an interesting stat that you threw out to me, and you always do this. He goes, hey, Vija, do you know Snohomish County had a 7.22% price reduction across the board last month? And I said, that is a very interesting data point to me. How did you find that? And he is on Locator. Many of our real estate MLSs around the nation use Locator. So this dashboard isn't just for the Northwest MLS. This dashboard should look familiar to a lot of you in many markets. And Anton's going to show us how.
Okay, so you can see my screen right now?
Mm-hmm.
Perfect. So a lot of the times you've got this market watch that's sitting right here. I'm going to just hit the reset button. So basically this is showing the NWMLS. You can see the total number of price reductions. The beauty of this is you can click on this customize button right here. And then, so I live in Snohomish County. So I'm just going to show you Snohomish County real quick. You can click on residential, click on Washington, come down here, find good old Snohomish County. Okay. And then I can just hit the save button. So the save button is going to show me that in the last, so we're looking at single family, in the last 7 days, there's been 118 price reductions. So if I click on these 118 price reductions, I can then check this magic all box right here. It selects all 118 of them. I can go down, print, and go CMA one-line portrait. The beauty of doing something like this, guys, this is how you become that local economist. You could do this inside of a zip code. PS, you can go into the map function and draw a circle around something. So you can make this as big, as small as you want. You could also add areas to the MLS. But the moral of the story is, let's look right here. So the average list price was $960,106. And then it got reduced to $897,000. Now, this is only the residential listings that had price reductions in the last 7 days. But one of the simple things that you can do in order to understand that is you just start, I'm trying to make my calculator small enough, start plugging in a little math here. Come back, calculator, to see what this looks like. So basically, you got to figure out the difference percentage formula. PS, I will drop this as a link on how to calculate it right into the chat box when I'm done. And
this whole video is going to be on YouTube, guys. If you get
Perfect.
on the Ben Kinney YouTube channel, it'll be on there by tomorrow. So
you can take your 960 plus 897,391. Divide that by 2, so I get basically the average of the two numbers. Then I take the absolute value, which is basically pick the big number minus the small number. 897,319 divided by 928,712 times 100. Okay, when I did this on Monday, the number was 7.22. I just did the number in front of you guys, and of course it's changed. So the average price reduction in Snohomish County for a single family home over the last 7 days was 6.7%. Very interesting to look at. Another interesting thing to look at, just look at the pendings. You can see they had less of a price reduction. And with that less of a price reduction, they were able to obtain a sale. So a couple things to be thinking about. One is you're getting in front of a seller and you're having a listing presentation. We need to go through and we need to say, your neighbor got 20 offers. You're probably not going to get that. We need to set realistic expectations up front. And this is where we have these types of conversations. You can also see that the ones that went pending, they were only just outside the market. So they missed it by just a little bit and they immediately went pending during that 7 days. So sometimes a minor price reduction will get you right into the market, but we have to really focus on pricing correctly and not pricing ahead of where we think things are going.
Yeah, and it is 2 minutes after the hour, so unfortunately we have to wrap. In 2 weeks we have our next network meeting. So if you guys want more of this, Anton and I can continue to come back. I think and I feel like this kind of needs to be a little bit of a real time thing, right? This is how I would like to close, if it's okay with you. Number one, complete gratefulness for you guys taking 1 full hour out of your day to teach everybody and bless everybody. So thank you, gentlemen, for that. The second one is that you need to make hay while the sun is shining. So what typically happens is we see a spike in activity if there is going to be a slight correction, that you see an artificial urgency to buy right now because everybody knows it is baked in. We are going to increase rates, right? You have a 90, 120 day, no one knows how long your window is, but I want to urge you and encourage you to take a look at your schedule and front load the rest of the year in the next 3 to 4 months. Because what if I'm wrong? If I'm wrong, you're going to have a great cash stash. Speaking of cash stash your cash. Now is the time for you guys to save money and take advantage of all these awesome opportunities and pocket. What did you call them? Pocket deals. I think you
Pocket value.
Pocket value.
Pocket value.
Thank you. Pocket value. Pocket values that Jesse talked about, right? Third, this is the time to take a look at expenses, right? You know, you don't have to go, no one needs to freak out, but this is the time to take a look at expenses, right? Rein them down, save your cash. I know it's losing a little money with inflation. I get that, but I want you guys to have the opportunity to take advantage of this downturn and build wealth. We will see you guys in a few weeks for all of our Wednesday webinar people. Thank you for watching us today. It was a little bit Pacific Northwest front, loaded, but I think it's applicable to the whole nation. Have a great day, everybody.